Hey, what's going on, everyone? It's Griffin here, and we have a big week ahead of us in the stock market with quite a few of the most heavily weighted big tech companies that make up the S&P 500 about to report their Q3 earnings. And as we all know, during earnings week, this can lead to quite a bit of market volatility, especially when it comes to these larger companies that have significant pull over the general market. Now, over the past couple of weeks, quite a few companies that have already reported their Q3 figures have exceeded Wall Street's estimates, even considering fears and concerns surrounding the possible impacts on bottom line figures stemming from the supply chain issues that we've been experiencing. In fact, according to FactSet, more companies are beating earnings per share estimates for the third quarter than average and beating EPS estimates by a wider margin than usual. And as a result of this positive earnings surprise, the S&P 500 is currently on track to post their third largest year-over-year earnings growth since Q3 of 2010, leading to bullish market movements. To date, before this upcoming week starting today, which is Monday, 23% of the companies in the S&P 500 have already reported their Q3 results, and of these companies, over 84% of them have reported EPS figures that are above analyst estimates at an average across industries of 13.4% above these estimates from Wall Street. To dig into the data a little bit more, this chart right here clearly demonstrates this reality where 100% of the companies having already reported in the communications, healthcare, materials, real estate, and utility sector have posted earnings above analyst estimates. The energy sector is definitely trailing the pack regarding earnings estimate beats. We're even seeing average EPS growth rates increasing since the real end of the quarter, which was on September 30th, for the companies that are set to report their earnings this week and beyond. What's more is that market analysts are now expecting earnings growth of more than 20% for the fourth quarter and revenue growth of more than 40% for the entire 2021 year, which is quite striking. However, we've already seen the S&P 500 expand by nearly 34% over the past year. So despite above average year-over-year earnings and revenue growth, could we be in a situation where once again these expected gains are already priced into the market price of the S&P 500 as a whole, and even more so these large companies? That's yet to be determined. All of this to say though that the above expected results over the past 2 to 3 weeks have definitely been felt across the S&P 500, where we're now back near all-time highs following a nice 5% increase since early October, with a slight taper coming into this week's trading where we'll be seeing companies like Facebook, Apple, Amazon, and Google reporting their Q3 earnings. Let's keep in mind that in terms of weighting, these four companies alone make up roughly 17% of the entire weight of the S&P 500, which is pretty massive if you think about it. And most investors do have exposure to these companies in one way or another, mainly usually as a result of holding an S&P 500 index fund, or ETF I should say, such as VOO or SPY in the US or VFV in Canada. In fact, most of these companies have significantly outperformed the results and returns of the broad market over 2020. But over the past 6 to 12 months or so, gains have definitely cooled off from the multiple double-digit growth figures that we saw last year, especially for Amazon, that's been trending sideways for roughly a year now, even though it remains one of my favorite companies to hold and throw money into for the longer term. Do keep in mind though that this seemingly monumental growth rate that only falls short of the past 2 quarters of this year is due primarily to a combination of higher earnings in Q3 2021, as well as an easier comparison to Q3 of 2020, where there were significant negative impacts on multiple different industries resulting from the pandemic. Now, even considering all of the current headwinds that major corporations have been facing across the board, such as chip shortages, blocked ports, and many more, we're still seeing larger financial figures continuing to be posted from an actual dollar figure standpoint, even though percentage-based growth may be tapering off from 2020. So we're definitely still seeing strong underlying financial growth across the board in the S&P 500. And this happens to also be during a period where we're still and very much actually just starting to feel the repercussions of the increased money supply that we've been seeing over the past 2 years, which has inevitably led to higher inflation levels across many sectors, as many, including myself, have been speaking about for the better part of a year at this point. Some individuals, including even high-level CEOs such as Jack Dorsey, are even fearing and predicting potential hyperinflation. Now, really though, do I think we're going to be seeing hyperinflation over the next couple of months, which by definition, according to Investopedia, means rapid, excessive, and out of control price increases in an economy, which can even surpass 50% per month. So with that in mind, do I think we'll be seeing hyperinflation in the realms of 50% or more per month for a sustained period? I kind of doubt it based on the data that I've been able to gather, even considering this increased money supply. So even though I doubt we'll see hyperinflation, one thing that is for sure though is that we will see increased and more prevalent inflation than prior years, especially in certain industries. In fact, we're already starting to see it. For example, the massive international food company Nestle is saying that we should expect to see pricing ramping up for food across the board. And even the CEO of Kraft Heinz is stating that inflation is across the board. People need to get used to higher prices, period. The point being though that until the Fed start increasing interest rates once again, which for the time being has been said to be by next year at the earliest, investors are still very much, and even more than last year, looking for places to park their cash and invest their money to try and yield a higher return than what they're losing out on in terms of devaluation of the dollar and loss of buying power simply by holding cash in a low-bearing, low-interest savings account right now, leading to certain markets and asset classes increasing in value and just taking in more funds. We've seen these charts before for the forward PE of American stocks, but they're updated periodically. So as of October 15th and moving into Q3 earnings, forward S&P 500 PE figures remain quite high despite underlying growth and are continued to demand considerable valuations, which I don't think we'll see correct until, again, interest rates start to rise. So to that, let's take a look at what's going on in Jerome Powell's office, where according to the Federal Reserve, they are currently on track to begin slowing the pace of its US Treasury and agency mortgage-backed security purchases, which is exactly what they said the plan would be as of last month. Powell has also mentioned that they're being patient and allowing economic recovery to take place with the labor market gradually healing, but that they would have no issue hiking interest rates to guide inflation back down to 2% over time if inflation levels reach above their target. Finally, he stated that if economic recovery does continue to progress as expected, the Fed could look to fully eliminate their quantitative easing program, which would essentially mean that they would be removing and entirely eliminating all forms of financial compensation resulting from the pandemic to a full stop really by mid-2022. So again, this is somewhat proof that just like back in 2020, the Feds definitely have a hand in the equity markets, at least when it comes to being able to provide resources to the economy to help maintain these price points and underlying valuations. But just like with the housing market, I kind of doubt we're going to see a large cool off until at least mid next year. There's just no reason for investors to massively liquidate their holdings back to cash right now, even considering these higher valuations in the market, to the point where many investors are even seeking out alternative assets and investments such as cryptocurrencies, where you can yield significantly higher results than if you were to be holding cash right now, and even average dividend yields. This is actually a topic that I spoke about in detail with Kevin O'Leary on my interview that I highly recommend you check out if you haven't already. All in all though, we're continuing to see positive financial growth leading to bullish market movements, and although expectations are high, which could lead to underperformance, I think Q3 will actually prove to be a nice period for the S&P 500 and these top companies making up the index. Let's now speak about a couple of these specific companies, starting with Facebook. So Facebook actually mentioned in their Q3 earnings report that they were expecting revenues as well as earnings to taper off in Q3 from a percentage growth standpoint, mainly due to increased ad targeting headwinds in 2021 from regulatory and platform changes, notably the iOS update. But nonetheless, earnings growth for Facebook are expected to be in the waters of around 37%, bringing them to potentially a record quarter at $29.45 billion. With that said, Facebook stock was hit hard last week, down almost 6% following Snapchat's terrible quarter and slow ad revenue growth, and it's now down roughly 15% from its all-time highs. And honestly, we'll see how earnings play out and impact the stock in the short term, but this is a company that I'm happy to hold, and my views haven't changed on the longer-term viewpoint for Facebook and their subsidiary companies. In fact, my position in Facebook in one of my stock market portfolios is currently up quite a bit despite the recent sell-off. And if we see the stock sell off even more considering this underlying earnings growth, I would not mind picking up more shares of the stock for, again, a longer term hold. And regarding the stock's valuation, it's currently trading right around its 3-year average price to earnings ratio. Moving on to Amazon stock, this is another company that's going to be reporting their earnings this week. And the stock price once again has just been subpar over the past couple of months. So over the past year, it's been trading pretty much sideways at this point, up around 3%, which is nothing to brag home about, especially considering the fact that this company has grown by leaps and bounds from an actual underlying financial standpoint over this same period. The thing about Amazon is that they have a very strong track record around investing into their own future growth and opportunities that are going to allow them to continue growing at an exponential pace as they have been over these past couple of years. As an investor in this company, I just see all of these as shorter term headwinds for the company as well as their stock. Amazon's growing at an incredible pace in multiple different industries and impacts more and more people's daily lives quarter over quarter. We can also see here that from a valuation standpoint, Amazon right now is actually nicely valued and undervalued relative to the market and even previous valuations that it has commanded in the past. All of this to say that I think we're going to be seeing a very nice earnings week for many of these companies, and I can't wait to see how this plays out in terms of actual market movements. Over the past couple of weeks, I've been buying into the market consistently, mostly through market indexes, both in large, mid, as well as small cap stocks. I still think that we're seeing higher value, or better value, I should say, in small and medium cap stocks. So that is making up an increasing part of my portfolio right now and moving forward. So I really hope you enjoyed today's video. If you did, make sure to smash the like button. And if you want to hear my thoughts and data around what I think will happen in the property markets based on concrete data that I was able to gather, make sure to check out this video right here. So on that note, thanks a lot for watching today's video, and I will see you in the next one.